Hi there, I'm Irked, and this is my channel, Get Irked. In this episode, is the stock market still a long-term wealth generator, or is it just the biggest casino on earth? In this episode, I wanted to talk about long-term investing, but first I wanted to acknowledge the fact that it's been 1 year since I started on YouTube, and I wanted to thank all of my viewers and subscribers for watching. Seriously, I really do appreciate it. Thank you for taking the time with me. Now that Get Irked has been on YouTube for a year and the Get Irked website has been running for nearly 4, I wanted to go over a little bit more about long-term investing and why I believe it could be the wealth generator for anyone who's willing to put in the time. I started Get Irked as a way to give back. I wanted to teach people for free. I wanted to show you the ways you could invest for the long term and earn money without trying to take huge risks in the stock market over the short term. For any of these websites or YouTube channels with VIP memberships or lesson plans on how you can learn how to invest, you'll read tons of negative reviews about all the people who've lost money. And while this might not be true for all of them, the vast majority of them aren't actually good at investing or trading. The money that they generate comes from you paying for those lessons. This is because people who know don't charge, and people who charge don't know when it comes to how to invest for the long term. You'll often hear people say, well, if it was really a good way to generate money, why would anyone teach anyone else how to do it? They would just keep it to themselves. And when it comes to short-term trading strategies, that actually tends to be true. The more people who use the same strategy, the less likely it is for it to work. My long-term investing techniques will actually work better if more people follow them. The idea of buying the stocks of quality companies and holding on to it for the long term will only increase the value of quality stocks. However, holding on for the long term is definitely easier said than done, especially when you see a market sell-off like what we saw in January of 2022. And spoiler alert, that's far from the worst sell-off that I've seen in the 25 years I've been doing this. When I created Get Irked, I wanted to create a non-toxic environment where people who didn't know how to invest could ask questions and not be attacked. Because of this, I thoroughly moderate the comment section of my videos and remove the toxic comments so that no one has to read them. It's cool to be excited about your position on a stock, whether you're long or short. However, going after other people isn't going to make any difference into what your thesis is going to do. Trust me, I've been doing this long enough that cheerleading your stock up or down is going to make no effect on the direction of the stock. An example of this was DraftKings. I made a video on DraftKings a few months ago where the stock was at $28, and I said that I wouldn't add to it again until the stock hit at least $20. And I had someone comment on the video, the stock's never going to $20, how new to the markets are you? And then over the upcoming days and weeks, this happened. Now, I'm not trying to call out this guy. It's cool that he was really bullish on the stock and didn't think it would break $20. However, I don't ever try to predict which way a stock's going to go. I'm really bad at it. So my videos focus on which way it could go and how far down it could go. As you can see, DraftKings ended up selling off down here to $17.41. So yeah, I wasn't right. It didn't stop at 20. It actually went down to $17.41. A drop of nearly 13% lower than my target, which the viewer thought was too low for the stock. And like I said earlier, I'm not new to the markets, and if there's one thing I've learned, it's that the markets will remain irrational longer than you can remain solvent. A quote from John Maynard Keynes. And rather than try to predict those moves, it's better to just know that they're possible and plan for them. If the worst case scenario never happens, great. You don't have to put money to work at unbelievably low levels, but you don't want to say the stock's never going to go that low and just not have any money because you're all in thinking it was only going to go higher. Next, let's go over a couple of steps of how to get started in long-term investing. Step 1, pick a broker, and you're going to want a broker that's able to stand up during the roughest times. And yes, I'm looking at you, Robinhood. That's not who you'd want to go with. My preferred broker is Schwab, and if you use my referral link, you'll get some money if you put in enough money into your account, but I don't get anything for referring you. Schwab honestly believes that I'd want to refer you because I think they're the best, and that's the case. Step 2, do you want to buy individual stocks, or would you like something with a little less risk? There's nothing wrong with buying index funds or exchange exchange traded funds, also known as ETFs, where you can set it and forget it and just not look at your investments and trust that they're likely going to go up over time. If you're just getting started, my favorite ETF provider is Vanguard. They have the lowest fees in the industry and they've been doing it the longest. The two Vanguard ETFs that I'd recommend looking at to get started with are VTI and VOO. VTI is the total stock market index. That means it's every single stock that's available all rolled up into one ETF. VOO is a play on words. Since it starts with the letter V, just like Vanguard, the OO might be a little bit confusing, but V is also the Roman numeral for 5, so it's actually 500, representing the S&P 500, although it's important to remember that tickers do not have numbers, so it's V, letter O, not V00. The S&P 500 is an index that tracks the 500 biggest US stocks. So while it will have very similar performance to VTI in a lot of cases, it also means that you don't get any exposure to smaller companies. So VTI is usually the one that I would prefer to go with if that was the only ETF that I was going to hold for my long-term investing. Step 3. If you wanted to look at individual stocks, you have to remember that you need to maintain diversification. What that means is you want to have at least 5 stocks and have each stock be from a different sector. That way, if you see a sell-off in a specific sector, it's not going to take out your entire portfolio. You're going to have protection because you're diversified. When you're picking individual stocks, I recommend sticking with the companies that you know with products and services that you have trust and faith in. It also helps to have companies that you're interested in following and keeping up with. If you're too bored to pay attention to the earnings call or learn what the company is doing, it's probably not a good investment. Additionally, when you look at what stocks to pick, do not focus on dollar value. A lot of people get wrapped up in being able to buy 100 shares of a $1 stock instead of 1 share of a $100 stock, and that's the wrong way to do it. You want to look for quality, and if a stock has a low dollar value, it usually does for a reason, which means that stock's probably not worth owning anyway. Step 4, how do you buy? Well, the way I take this approach is I like to buy my initial allocation of about 50% of my entire amount that I want dedicated to a stock. Once you've bought your first 50% allocation, I save the remaining 50% to buy in stages on the way down. If you've watched any of my videos about specific stocks or ETFs, you'll see that I use past price action to determine what level I might want to buy at. However, you don't have to do that. You can buy in 5% increments, buying at 5, 10, 15%, and so on. Or you can dollar cost average over time, where you just set a day of the week or month where you just keep adding to your positions. The prices that you choose to buy at are pretty arbitrary. The key thing to remember is that it's time in the market, not timing the market, that matters. As long as the stocks of your company continue to go up and the company continues to perform, it's a great long-term investment and there's no reason not to hold it. One of my rules is buy on red days and sell on green days. And what that means is that you only buy a stock when it's selling off and you only sell a stock when it's gaining in value. The reason for this rule is it takes emotion out of the equation. A lot of people try to protect against losses, but when you're talking about long-term investing, you should never make a short-term decision about a long-term investment. A friend of mine owned Nike and it was supposed to be a long-term investment, but he was worried it was going to drop below $130. So he used what's called a stop loss, which would automatically sell his shares if it dropped below $130. After a couple of days, Nike did sell off below $130 and went as low as $126.68. So it looked like it actually worked. His stop loss prevented him from losing a little over 2.5%. So it seemed like a good idea and he had every intent of buying lower, except then Nike reported earnings. And the earnings were so good that Nike jumped 20% in a single day. So while he protected himself against a 2.5% loss, he lost out on a 17% gain from that low. If you're investing for the long term and you're buying the stocks of quality companies, you need to look at sell-offs as sales where you can add to your position, not as reasons for you to take losses and get out of a position. You're in this for the long term. And when I say long term, I mean a significant time horizon of at least 5 years. In my case, I'm not planning to be able to retire for 20 years. So when I see a giant sell-off in one of my positions, I buy more. I don't take losses. That being said, there are always reasons where I do sell a position, but that's because my thesis changed. For example, this is the chart of AT&T, ticker symbol T. I originally owned this stock because I wanted to have a wireless provider with the streaming kicker that AT&T had. They own Time Warner, which also owns HBO, and I thought it was good to have that kind of exposure. In addition to that, AT&T offered a dividend yield of more than 6%, so the combination of the dividend yield and the streaming service was why I wanted to own AT&T. On May 17th of 2020, AT&T announced that it would be spinning off the Time Warner streaming division and it would be cutting the dividend. And while initially the stock popped on this news, I sold immediately because it invalidated my thesis. And it turns out that was a really good move. And so there are reasons that you should sell. But if you still believe in the company for the long term, you shouldn't sell just because there's a market-wide or company-specific sell-off unless whatever happened actually broke your thesis, in which case, yeah, cut your losses and get out. The rest of the time, it's a buying opportunity. If you've been watching investing videos, you've probably seen that there are two camps of investors, those who follow the fundamentals and those who follow the technicals. And oftentimes, both of them will fight each other about which one's right. My investing style takes into account both the fundamentals and the technicals. So if you look at my videos, you'll see that I go over the fundamentals and then I create a buying plan using the chart and past price action to find levels where there might be support. Some people will refer to technical analysis as astrology, as if you're just trying to make up a story of what's going by looking at the charts. But what I've found is that price levels really do hold. If a stock sells off to a specific price in the past, the chances are that price will provide support into the future. Thanks to stockbrokers eliminating fees in terms of commissions and maintenance fees, I really believe that long-term investing is one of the best ways for any American to be able to build wealth into the future, no matter how much money they make. I release at least one video a week on my YouTube channel. However, every week I do a week in review where I look at all the news that moved the markets as well as the crypto markets, including Bitcoin. I keep a shopping list which I update almost daily with the price targets for each one of my positions where I'll add more. And I have a myriad of articles that I've written since I started Get Irked in August of 2018, and all of it's available free of charge when I'm not on YouTube. So check out my website at getirked.com. If you have any questions or any topics that you'd like to see me focus on when it comes to videos, please leave them in the comments. Like I said earlier, I do read every comment and I'll use it to make videos into the future. In the meantime, watch the other videos on my channel for more, or go to www.getirked.com where I give tons of content every week.